Hello, everyone, and thank you for joining us today. I'm Rachel Branson, the Professional Development Manager here at NC Realtors. Today, we're going to be talking about all sorts of financing products and programs that are available for you to use while helping consumers to purchase their next home. But before we get started, I want to cover just a few quick housekeeping items with all of you. First, we'll be taking live questions via the Q&A field at the end of today's session. We will also be recording today's session, and we'll make sure to email all of you a link to that recording. So now I would like to welcome all of today's speakers. Today, we are joined by Jim Hall from Freddie Mac, Dennis Smith, also from Freddie Mac, Jane Kavanaugh from the North Carolina Housing Finance Agency, and Karen Moravis from Fairway Independent Mortgage. Welcome, everyone, and thank you so much for joining us today.
Thank you.
Thank you, Rachel.
Wonderful. So we've got a lot of ground to cover in today's session. So I'm going to go ahead and pass everything over to Jim to get us started. He's going to be giving us an overview of Freddie Mac today. So Jim, go ahead and take everything away.
All right, Rachel, thank you for inviting us back. We had a great event last year, and hopefully your members will, find a lot of value in what we're going to present today. We have a great group of speakers. Our business partner, Jane Kavanaugh from North Carolina Housing is with us. Karen Moravis from Fairway Independent Mortgage, and my friend and colleague, Freddie Mac, Dennis Smith. So everyone, you'll be getting a copy of our presentation, so you don't have to jot all the items down that we're going to be speaking about. And also North Carolina Realtors will be recording this session so you can go back and get the information visually and audio wise after the event. So again, I'm Jim Hall, Freddie Mac. I'm an affordable lending manager. My main focus is on relationships with housing finance agencies up and down the East Coast. I help them with developing business development strategies with realtors like yourselves and lenders like our friends at Fairway Independent. And, our purpose is to raise awareness and educate the industry on affordable housing and the lending products that are out there. But first, I'd like to give you, a bigger picture on what Freddie Mac is and what we do. We're a government-sponsored enterprise. You may have heard the acronym GSE out in the industry. We were created and chartered by Congress in 1970, so we were very proud to have our 50th anniversary last year. We operate in the secondary mortgage market. Now, we have a main mission, which is a three-part mission, and that's to promote liquidity, stability, and affordability in the marketplace. We also have community missions and three main business lines. One being single family, which I'm part of, and that focuses on 1 to 4 unit properties. We also have a multifamily division, which is 5 units and above, and our capital markets division. Now, we have 4 main pillars which we build our business upon: insights, education, mortgage products, and business solutions. With insights, our senior management challenges us with thought leadership. They present to us speaking opportunities. We have a great data and analytics team that provides us, information that we can use in certain segments throughout the country in building these business development strategies that I mentioned earlier. We also have mortgage products, and these products are used by Freddie Mac lenders, and they are, affordable type products. And I will focus on the HFA Advantage program a little bit later, as will Jane and Karen in their discussions. Also, we pride ourselves in education. Financial literacy is the key to success in our business for us and for our borrowers. And I'll share with you some resources and tools to further the goals we have in financial literacy. And also on that theme, our business solutions, we have a great wealth of resources and tools for real estate professionals like yourselves to use that will help you again in building your business strategies. I've always loved this slide here. It gives a great visualization of how many people and how many companies a prospective home buyer and borrower can really be involved in the home buying transaction. It takes many hands to make this possible and a lot of partnership. And we built this bubble chart to really put it into perspective. And at the top you see you're there, real estate professionals, because the genesis of the transaction starts with you. And then you hand it off to a loan officer, and the consumer is really trusting yourself and the loan officer to really guide them, through the process. Now, housing finance agencies and Freddie Mac, we're more in the background because we're providing programs and liquidity in the marketplace to make this all happen. But again, like I said, this is a neat little, conceptual piece that hopefully, puts it all into perspective on really what a home buyer, goes through the process. And as I mentioned earlier, housing finance agencies are one of, my main focus with my job. And it's really important to know what a housing finance agency is. They really started being born out of the 1960s. Lyndon Johnson was president at the time, and he had a vision for America called the Great Society. And he's most famous for the civil rights legislation and the Voting Rights Act that he signed. But in 1968, he also signed the Fair Housing Act. And with that, Johnson's administration knew that they couldn't provide affordable lending and housing to the nation on a federal level. So they took it to the states and the communities and asked for them to really buy into the vision and help, because they are the subject matter experts in their particular areas, just like North Carolina housing is in your state. So I'm a veteran of housing finance agencies. I worked for New Jersey Housing for 12 years prior to Freddie Mac. So I know how important they are in identifying, which areas and which communities need the most help when it comes to affordable housing and affordable lending. So where does Freddie Mac fit into this with housing finance agencies? Actually, we're the perfect partner for them. Again, housing finance agencies are almost like little Freddie Macs, because housing finance agencies are dealing with lenders who are putting their programs out there in the marketplace. So Freddie Mac, we developed the HFA Advantage program for lenders to use specifically through our housing finance agency partners to help with achieving the affordable lending and housing goals that we have. So what a lender does is they originate the HFA Advantage loan, and then they pass it and sell it to the housing finance agency. Then the housing finance agency sells that loan to Freddie Mac. So that's where we provide the liquidity for these programs to keep them going. Now, HFA Advantage is our most affordable program that we have on our product menu. It's a 3% down program. So it beats FHA lending by 0.5%. And that means that the borrower has to bring less money to the table. It does have income limits and home buyer education requirements. We defer to the housing finance agency, and Jane will speak to that later during her discussion. We also have charter level mortgage insurance, which makes it more affordable for the consumer. HFAs have made a great impact, within the past 50 years. They've really helped lower to moderate income folks attain the American dream. And as you can see on this slide, they've provided over $450 billion in financing, over the past 5 decades. So just some of the highlights of the HFA Advantage program: it's for single family residences. It can be used for purchase or no cash out refinancing. That's determined by the housing finance agency. As I mentioned, it's 3% down. So it's a 97% loan to value. There's 105% total loan to value. So that allows for a down payment assistance second mortgage to be placed, behind our first mortgage. All of the HFA Advantage loans have to be underwritten through Loan Product Advisor. That's our automated underwriting system. It's known as LPA or LP in the market. So that's critical that they have to get an accept approval through LPA. There's no reserves required, but I always encourage lenders to, if the borrower does have some cash assets, put it on the application, the 1003, because it strengthens the deal and just increases their chances of getting an approval. As I mentioned, income limits are determined by North Carolina Housing, and this is available for first-time home buyers, repeat borrowers, and borrowers seeking out no cash-out refinances. North Carolina Housing will determine, who they're going to open this program up to. So again, it's a great alternative to an FHA loan, which is much more expensive for the consumer. I mentioned charter level mortgage insurance. On a standard conventional loan at 97% LTV, 3% down, the coverage is 35%. And you can see that in the lower right-hand corner there. On the HFA Advantage program, we've almost cut that in half. So at 3% down, their coverage is 18%. So it's a substantial monthly savings for the consumer. And again, making the HFA Advantage program our most affordable product. Housing finance agencies have really been at the forefront for decades in serving the underserved borrowers, the lower to moderate income folks. So I thought this was a nice graphic to share with you to show you the market area. These are national numbers. For HFA home buyers, the median income for single family borrowers in 2019 was just shy of $51,000. And all home buyers throughout the nation that same year were $93,200. So again, this is a good visualization for you to know what type of borrower that the HFAs are really serving. And also housing finance agencies have also been leading and at the forefront of serving borrowers of color. Now this is a look back from 2001 up to 2019 of loans made by housing finance agencies and loans made in the market. Now the red line is loans made by housing finance agencies. And as you can see, they have been either at above or equal to many years for serving people of color. Now Freddie Mac has also made this a community mission. We've just created a department for equitable lending, and we're working very hard with our lending partners and our realtor partners to bridge the gap between white home ownership and African American home ownership, and also Hispanic home ownership. And I mentioned to you earlier, one of the pillars that we have focuses on the resources and tools and business solutions that we provide to our business partners. So you as a realtor, I really encourage you to sign up for our Real Estate Professional Resource Center. This is a great tool for you that will provide you with industry trends, key topics that will drive business and empower your clients. So we promise not to spam you or stalk you. We will only give you relevant information that will help you to build your business strategies. And I also encourage you to take a look at our CreditSmart financial education. This is our main financial literacy tool. We've been promoting it for 20 years, and we're very proud of it. And it's a 12-module curriculum that provides the consumer on topics for managing credit, money management, home ownership, and so forth. It's free, it's online, it's interactive, it can be done at their own pace, and it's done in multiple languages. And another thing of beauty for you as a realtor, if you are really out in the front of your community and you want to be a community leader, we have a train-the-trainer opportunity for you in CreditSmart, where you can become a certified CreditSmart instructor. And we have classes coming up this fall for this. And what it will do, it will allow you to either sit on one-on-one sessions or larger sessions with prospective first-time home buyers, and you can teach them financial literacy. Because I can tell you, I graduated high school in 1979, and we were prepared back then. We had business math courses. We were taught how to look at our bank accounts, how to prepare a budget, be ready to pay your insurance, your energy bill, etc. Be able to pay rent and make mortgage payments. That's really not being taught in our schools anymore. And that's why we're, as I mentioned earlier, you as a realtor, you're at the front line. The genesis, again, of the transaction starts with you. So you can be really, really, a valuable community leader if you're out there and educating, the younger people and the millennials on really how to do this. So you can always reach out to me at james_hall@freddiemac.com, and I can get you in touch with the Freddie Mac individuals who manage this program if you're interested in becoming a CreditSmart instructor to hold these workshops. And also part of the CreditSmart suite, we have Homebuyer U, whereas CreditSmart as a whole is a financial literacy tool. Homebuyer U just focuses on homebuyer education. Again, it's self-paced. This is 6 modules. It's a great, investment for a prospective homebuyer to sit down and take the time and really, really, absorb the information that we're providing to them. My slide says it's offered in English only. Just recently, I need to update this because it is offered in Spanish, and we're very happy to, be able to, make that opportunity available to our Spanish-speaking clients also. So again, if you want to pursue being a CreditSmart instructor, please reach out and contact me. And you as a realtor, you're the critical link. It all starts with you. We're all fiduciaries in this, during this transaction. The prospective home buyer and borrower, they bring their trust to us. And what I mean by that is, they know that we're the industry experts. So they're looking at you to provide them the most affordable house that meets their needs. And then lenders, are also a fiduciary because they need to present the most affordable program that fits their budget and their needs. So, again, the education, the financial literacy, part of this process is extremely important. We're here to dispel the myths of, the conventional lending needs 20% down and the myths that surround housing finance agencies, because again, they're a major part of the ecosystem. And at this time, I'm going to wrap it up, and I'm going to turn it over to my friend and colleague, Jane Cavanaugh, who is, works for the North Carolina Housing Finance, and they have tremendous programs and information. So Jane, if you can come on screen, I just stopped sharing mine so you can share yours.
All right, so let's see. We only practiced 5 minutes ago. Let's see if I can get it right.
I'm sure you will.
It doesn't look like it. Which one are you seeing?
You got it. It just came up. I can see it.
Well, that will never happen again. So thank you very much. I'm sure that some of you have been in Financing Dreams, which is our 4-hour CE, and we are not keeping you that long. We are the North Carolina Housing Finance Agency, and our mission is to create affordable housing opportunities for North Carolinians where they're not met by the market. We partner with Freddie Mac to offer a great conventional program. And typically, if your borrowers can get a conventional loan, it's going to be a better fit for them, a more affordable product for them in the long run than perhaps an FHA or another loan program would be. We've had more than 100,000 home buyers across North Carolina use our products over the 45 years we've been in business. And what we're going to talk about first is our NC Home Advantage mortgage. So one of the myths that people generally think about when they think about a housing finance agency is that we are limited to working with first-time homebuyers. And that is not true. North Carolina Housing Finance Agency can also help your home buyers who have already owned a home in the past. They may even own a home now and want to be able to purchase another home and keep their current residence. And they can do that with the NC Home Advantage mortgage. This program helps both first-time and move-up borrowers. So there's no prohibition against being first-time home buyer, but it's not a requirement either. Our interest rates are going to be competitive. It's not our job to try to beat Karen at Fairway, but sometimes our rates will be better because of the unique features that we have, because we don't have any kind of adjustments for a lower credit score or a lower loan amount or a high loan to value on these conventional products. On every home advantage mortgage that we offer a component of down payment assistance. So we do conventional lending, and we love our conventional lending programs, but we also offer government loans like FHA, VA, and USDA, and down payment assistance is available for those also. One of the greatest combinations you can give your home buyer is if you were to combine that conventional loan product with a mortgage credit certificate. And a mortgage credit certificate is a tax saving vehicle for your home buyer that can last up to 30 years. As long as they own and occupy that property, it can save them up to $2,000 a year on their federal taxes, which goes to helping make that home affordable. So we want to make home ownership attainable. We try to do that with good interest rates and down payment assistance. And then we want to make it sustainable. And the lower payments help that, but so does that tax credit. Who can use our programs? Well, anyone who is purchasing their primary residence in the state of North Carolina. So if you have them transferring in from out of Mongolia, that's okay. As long as they're purchasing their primary residence here, then they are eligible for our products. Currently, on the NC Home Advantage mortgage, our annual qualifying income is $92,000. And qualifying income is very important. It's very important for your lender to understand. Qualifying income is what the lender uses when they put that loan through the approval engine, the automated underwriting system, LPA for Freddie Mac. That's income that is considered reasonable, reliable, and likely to continue. And it's what the lender can rely on that you'll have to be able to repay that mortgage. Currently, that income limit is $92,000 no matter what county you are in the state of North Carolina. The maximum debt ratio, and that means that your house payment plus other repayable debt like student loans and car payments, credit cards, cannot be more than 43% of your gross income. Now, I know some of you are going to say, why can't you do 45? FHA will do 50. Why are you stuck down there at that 43? Well, if you remember back to the slide that Jim showed about the average income for home buyers that use housing finance agency products, even though we go to 92,000, the average home buyer using an HFA is somewhere in that $50,000, $55,000 income range. And if you think about 43% of someone's gross income, 43% of an annual income of $50,000 is a lot more significant to that home buyer than 43% of somebody who makes $100,000 a year or $150,000 a year. And so we want our home buyers to be successful. And so by keeping that down debt to income ratio a little bit lower, we feel like it keeps our home buyers more successful, that they are more likely to be able to retain their homes in times of trouble like COVID. And we don't really foresee that going up because we feel like this is a service to our customers. We've got minimum credit scores of 640 if your customer is purchasing a stick-built home or for new, never occupied manufactured homes, we have a slightly higher credit score of 660. Conventional borrowers who are at or below 80% of area median income, and that's calculated based on Freddie Mac's lookup tool. And I think probably, Rachel, we can get you that lookup tool, that link so that you can send that out. They get that charter level mortgage insurance. When you bump up over 80% AMI, you get standard mortgage insurance. But when you're at that 80% area median income or less, based on the lookup tools from Freddie Mac, you're going to get charter level PMI. So as Jim was explaining to you, that's an 18% coverage. But if you think about it, if you've got a $100,000 loan out there, standard coverage is 35%, which means you'd have to insure $35,000 against loss. 18% coverage means you only have to insure $18,000 against loss. Now, it doesn't take a rocket scientist to figure out which of those things would cost you less to insure. And that means your mortgage insurance payment is lower. And that means your total house payment is lower. Also, on a conventional loan, you are able to do a one-time upfront payment on mortgage insurance. You can do split premiums, which lowers the monthly cost. And that may help your borrowers get qualified. It may keep that monthly payment more affordable for them every time they have to make that house payment. Our income limits and sales price limits are getting ready to change. Sales price limits we have on the $8,000 product and on the tax credit. That will change probably at the end of May or sometime in June. So you will always want to check our website and make sure you've got the most current limits. That down payment assistance, excuse me, guys. On our conventional product, we can go up to 97%. Now, one of the really nice things is that even though a lender can offer that 97% conventional, to get that 97%, unless they're below 80% AMI, I believe, if I'm correct, they have to be a first-time home buyer. But for our product, your customer can be over that 80% and still get that 3% down payment, that 97% max loan, and be able to also use a 3% down payment assistance. On the FHA, VA, and USDA, we also offer down payment assistance of 3 or 5% of the loan amount. If your customer is a first-time home buyer, we offer a special product called the NC First Home Advantage, and that is an $8,000 down payment assistance product. All of our down payment assistance is deferred. It's not a gift or a grant, it's a loan, but it's a forgivable mortgage, second mortgage, that is fully forgiven by the end of 15 years. It's a 0% interest rate, it doesn't accrue any interest, and there are no payments due on it. It's completely forgiven at year 15, and it reduces by 20% per year going in years 11 through 15. For our FHA, our Freddie Mac Conventional Housing Finance Agency Advantage, the borrowers have to be at less than or equal to 80% area median income per their lookup tool. Both repeat borrowers and first-time home buyers are eligible for this product. Up to 97% loan to value is available even for repeat buyers. There's a 3% down payment assistance that we also offer. If they are first-time buyers, they could get the $8,000 with this product. It's charter level mortgage insurance and a lower interest rate. If you're at 80% AMI or below, you get a better interest rate. This is what their lookup tool looks like. Properties, new or previously owned single-family homes, whether they're stick-built or modular, new manufactured homes with a 660 credit score or better, townhouses, investor-approved condominiums, and on the FHA, if you are not using the first-time home buyer, you can even buy both sides of a duplex and use our down payment assistance to help you do that. So let's see, I wanted to ask you a question. What do you think? Does your customer have to be a first-time home buyer to use the North Carolina Home Advantage mortgage? And that is false. On our regular Home Advantage mortgage, you do not have to be a first-time home buyer. And qualifying income is income from all occupants. And that's also false. Qualifying income is just the income that the lender uses to get your borrower approved, to tell them that there's enough money there to make sure that they can repay that loan every time that mortgage payment comes due. Because let's face it, a lender wants to know they're going to get paid every month. Like me, I like to know I'm going to be paid every month. The Community Partners Loan Pool is a separate program that we have at North Carolina Housing. It is from a sister department. It's a great product. It is for borrowers who are at 80% or below of area median income, and that is based on North Carolina Housing's AMI. It provides up to $30,000 in down payment assistance. This program prefers new construction or newer construction, but since there is such a housing shortage in North Carolina, they are looking at properties. They will do properties that are a little bit older, but there are a lot of inspections that you would need to go through. Your home buyer has to go through a community partner, and there's the link where you can find our community partners. The community partners will give them the 8 hours of home buyer education that's required. Many of these home buyers are able to use a conventional loan program because they have that 20% down. And these programs can be stacked with other down payment assistance products. Like if you're in Charlotte, you can use House Charlotte. If you're here in Raleigh, there's the City of Raleigh. If you're in Greensboro and High Point and Winston-Salem, they all have down payment assistance resources through those cities and counties. And I think Karen is going to give you some more information about those. This takes a little bit longer to close this product. You need to allow 6 days from the time of approval to closing. And the experts on this program are Josh and Rich, and I've sent you their email addresses because they will be able to give you all the answers. Our First Home Advantage, the clue that this is going to be different is because it has the number 1 in there, right? And First Home Advantage means that your home buyer is going to have to be a first-time home buyer or meet some exceptions. This does have a family income limit. The family income means that all the income received by the owner occupants in that property. So that means anybody that's on the mortgage, their spouse, and anybody else they put on the deed. So here the warning is, don't put them on the deed. If you don't put them on the deed, they don't count as part of family income. So adult children don't count. They live with you, just don't put them on the deed. Fiancés don't count, don't put them on the deed. But family income will be every nickel that that person does get. So all of the money from any owner occupant will be included in family income. There's a maximum sales price of $290,000. That's about to change. First-time home buyer or meet certain exceptions. This cannot be used with a mortgage credit certificate because of our funding source is a mortgage revenue bond, and that's the same source for the mortgage credit certificate. The down payment assistance, that $8,000 can be used to help pay closing costs. It can be used for down payment. Obviously, you can even use it to pay mortgage insurance off up front. So you can get it and pay off all of your mortgage insurance up front and have just principal, interest, taxes, and insurance, which is a great low payment for your home buyer. The mortgage credit certificate is a tax reduction. It reduces the amount of federal tax that your customer owes. They can claim it every year as long as they own and occupy that property. It's worth up to $2,000 a year in tax reduction, and it's $1 for dollar. You don't have to fill out Schedule A to get it, but your home buyer has to be approved for this prior to closing. For new construction, they can save up to 50% of the interest, but it's always capped at that $2,000 per year. The remaining 70% or 50% can still go on Schedule A. It can help your borrower qualify for a loan, and you do not have to itemize to get credit. You get to take the credit whether you are itemizing on Schedule A or not. Only first-time homebuyers are eligible for the North Carolina First Home Advantage 8,000 and the mortgage credit certificate. That's true, unless they meet certain exceptions. You can combine the MCC and the NC First Home Advantage 8,000. And that one is false because the money's coming from the same source. You only get to have one piece of that pie. You have to select whether it's going to be the 8,000 or the mortgage credit certificate. But you can combine the mortgage credit certificate with our NC Home Advantage mortgage as a standalone or with 3 or 5% in down payment assistance. Our programs are easy to use. You go to a knowledgeable lender like Karen. We've got lender partners all over the state of North Carolina, hundreds and thousands, really. All of your loan officers have to go through training. Hopefully they are all familiar with our products to help you, but if you have any questions, don't hesitate to ask us. And here are some email addresses, and generally we're all easier to get hold of by email. Bill Hobbs is our lender liaison. He's able to be there and answer questions for you. There's me, Jane, and then my boss is hiding at the bottom, Rob. But as you can see, our underwriters are fully accessible. But if you have general questions, if you'll call Bob, me, or Rob, and then Margie helps with anything. If you're already an approved or preferred real estate agent with us and you need to change any of your information, you can call me or Margie and we'll be glad to update your information. And that, my friends, is what I have for y'all today.
Thank you, Jane. That was a great presentation. I love the flash quiz. I let you know I passed. I got all the questions right. So, so you're a good teacher. And our realtors in our audience, you know, the residents of North Carolina are really, really lucky to have an organization like North Carolina Housing to provide these tremendous programs, you know, to the constituents of North Carolina. So yeah, what you've seen here is a theme of partnership. And now we're going to have Karen from Fairway Independent Mortgage Corporation speak. Now, Fairway Independent is another tremendous partner of Freddie Mac. They're a past winner of our RISE Award for producing the most HFA Advantage loans nationally. And, you know, Karen is a, you know, a great proponent of that program and a great business partner. So Karen, time is yours. Thank you for being with us.
Awesome. Thank you so much, Jim. I appreciate the opportunity for you and Rachel to invite me to be a part of the presentation. I think these programs are just truly, from the bottom of my heart, a necessary and very important piece of what we can do for so many customers in the state. You know, you mentioned the myths earlier about conventional loans being required 20% down. And I still find in speaking with customers on a daily basis that there are so many people that don't realize that there are opportunities out there. And these programs are just amazing. So thank you for allowing me to be a part of it. So let's talk a little bit about what the process looks like from the beginning first. You know, at Fairway, we try really hard to keep the process simple. You know, the adage and the acronym KISS, keep it simple, silly, or keep it simple, silly. I've heard a couple other ways to say that, but we'll keep it with that one for now. We really just want to give the clients the opportunity to apply in various different ways that's convenient for them. And during the pandemic, this global world that we're in right now, it really does help to be able to offer some application options virtually. So we can do that through Zoom meetings. We can do it over the phone. They can go securely online. We actually have a phone that so many people are using on a daily basis, and it makes the process more streamlined for the consumer. So we like to promote that as often as we can to get more people into homes, and we're offering different options to meet all of their goals. You know, part of what we do in conjunction with our realtor partners and Jane over at North Carolina Housing and Freddie Mac is that we become consultants to the consumer. We talk to them in detail about what those needs and their goals are so that we can really streamline what the program is best, what program is best suited for them, and provide them with all the options for them to make an educated decision on what they feel is best for their families. We offer purchases, refinances. There's a renovation option that Freddie Mac offers as well. And of course, there's some reverse for any home buyers or those that need to refinance that are over the age of 62. Fairway is committed to making sure that the customers understand the process from start to finish, and that we're keeping not only those consumers, but also our realtor partners and our builder partners well informed from day one, from the start of the process all the way through. We are offering programs that include both fixed rate and adjustable rate mortgages in all of those programs that we've already heard both you and Jane talk about: FHA, VA, conventional, and the rural housing program through USDA. We love, love, love talking to people about first-time homebuyers and the various down payment assistance programs and the MCC options that are offered through North Carolina Housing Finance Agency. And of course, we have some jumbo products to assist those higher end purchases. So let's talk about some of the basics. Maximum mortgage amount in most of North Carolina in 2021 is now $548,250 for a one-unit home. There are some higher amounts available if we're looking at multi-unit properties. But for the most part, we're going to be looking at a maximum conventional loan amount of $548,250. Now, there are 3 counties in North Carolina that do allow for a slightly higher maximum loan amount. Camden is one of them. And you're going to forgive me because after 20 some years in the Carolinas, I still, for the life of me, can't pronounce all of the wonderful and interesting names that we have for some of our cities. So those 2 counties that we have there on the screen will also offer the opportunity to go a little bit higher in the price point if need to. Primary residence, second home and investment properties. Let's look at those down payments. Primary residence, you can do as little as 3% down with some of those Freddie Mac programs that we talked about. You know, of course, you can go up to 20% as well. That will allow you to avoid some private mortgage insurance options. And second home vacation properties, you're going to need 10% down for those. Investments can go as low as 15%. But I will say the consumer is going to get the most bang for their buck rate-wise and cost-wise if they are looking at a 20 to 25% investment as a down payment for that property occupancy type. PMI. So PMI is based on the credit score and the down payment requirements. If you start off with PMI on a loan, you're required at a minimum to have at least 2 years into your loan to be able to drop it, assuming that your value increases within those 2 years. So what does that look like? Let's say you're 2 years down the road and you don't want to go out and refinance, but you're willing to pay for another appraisal. You can work with your servicer and have a new appraisal ordered to show that you are now at a 20% equity position in your home, or that your home has reached 22% of the original value when you closed on your mortgage. So the conventional loans do provide an option to drop PMI eventually. Seller concessions. So what can the seller pay? The seller can pay up to 9% on a loan to value where the consumer is putting 25% or more down. 6% if your loan to value is 75.01 to 90%. So anywhere between a 10% to a 24.99% down payment, the seller can pay up to 6% for seller concessions. Anything greater than 90% loan to value or less than 10% down payment, then the seller is capped at a maximum of 3% that they can pay towards closing costs and prepaids. All investment properties are automatically capped at 2% concessions. Qualifying ratios are determined by the automated underwriting decision engine. So for the most part, we're going to look at ratios on a conventional loan somewhere around 30% on the front, and we really don't want to exceed somewhere around 43 to 46% on the back. However, that being said, depending on the strength of the borrower's overall financial profile, it's very, very possible that we could see credit score, or excuse me, ratios exceed those numbers that I just gave you. I've seen Freddie Mac accept borrowers with a 32, 33 on the front housing ratio and as high as 48, 49 on the back for that total debt to income ratio. It's really going to be driven by the strength of the credit and the strength of reserves. So the decision engine just loves to know that the borrower's got some money in the bank post-closing. In the event that they should fall into some hard times, then they've got funds that they can fall back on to get them through that hiccup in their circumstances. Ideally, you want to stay in the mid to low 40s for a conventional loan. Now, another benefit to qualifying on a conventional product, specifically with Freddie Mac, is that Freddie Mac will allow student loans to, the student loan payments to be calculated lower than what you will find on other loan types. So generally speaking, once upon a time, student loans, if they were in forbearance or deferment, we did not have to consider that in the qualification for the buyer. However, several years back, that that program changed, that policy changed. And regardless of whether the home buyer is in a forbearance or a deferment situation, we have to count at least 0.5% of the outstanding balance of that student loan against the borrower for qualification to ensure that when those payments do resume, that the home buyer is in a position to maintain those without feeling strapped. And hopefully that cash flow will be comfortable for them. Now, Freddie Mac will also accept if the borrower is in a student loan income-based repayment plan, which is not something that our HUD counterpart will accept. HUD requires a 1% balance calculation, and they will not accept an income-based repayment plan. So this helps the buyer qualify for a little bit more home because we don't have to hit them as high for those student loan payments. Credit score requirements on a conventional loan. Fairway does require that the buyer have a 620 median FICO score, and there are no score options available for those buyers who do not have the traditional credit, and we need to get creative to help them satisfy the requirements there. Gift funds, this is another, gift funds is actually a big qualifying piece for conventional financing. It is easier to go conventional with gift funds than it is FHA. Not that they're harder, it's just less paperwork. So gift funds can be provided for down payment and closing costs as long as the acceptable donor is a relative related by blood, marriage, adoption, or legal guardianship, or that the gift donor is a fiance or domestic partner. What makes this easy to document for the purposes of a conventional Freddie Mac loan is that all we really need is a gift affidavit signed by the borrower and the gift donor. And then at the time of closing, the gift donor simply wires the funds to the closing attorney. It can be as simple as that. There's no crazy documentation that we need to go through to make sure that we're documenting the transfer of funds from the donor's account to the borrower's account and all of that jazz if the funds can be wired directly to the attorney. And that's typically how we like to structure it as long as it works for all parties. Freddie Mac conventional loans, there are no sales price restrictions. So guess what? You could buy $1 million home as long as that primary loan is less than or equal to the maximum conforming loan limit, which we said was, generally speaking, in North Carolina, $548,250. You can take out a conventional loan. There are no income restrictions except for some of the specialized programs that we've discussed already. And there are no location restrictions. So you can purchase and use conventional financing with Freddie Mac throughout all 50 states and a couple other places. So let's talk about that minimum down payment assistance program through Freddie Mac. For conventional financing, most people think of 5% down as the minimum. However, there are some circumstances where a home buyer may qualify for a Home Possible or a Home One conventional loan. Both of those products offer financing as long as the buyer has a minimum of a 620 median score. Both require homeowners counseling. The Home Possible has an income limit that is 80% or less than the area median income for the property location. So I believe it was Jane showed you earlier where you can go out and do a quick search for the Home Possible eligibility site. And you plug in the address of the property, it'll pop up what the 80% area median income limit is for that area. And that's what we go off of for the income limit. Now, the Home One program does not have an income limit. So that's a little bit more flexible. Both allow for a minimum of 3% down, with the exception of the Home Possible program. If the buyer does not have a FICO score, then at that point, the minimum down payment would be 5%. So you might ask yourself, why would I go with a Home Possible program as opposed to just a cookie cutter normal conventional program? Well, the Home Possible program will give the home buyer the benefit of the reduced PMI coverage that Jane and Jim both spoke about earlier today. Whereas the Home One program, that PMI coverage is the standard normal customary coverage. Both do require that the home be a primary residence. Neither program will accept manufactured homes, but the Home One will also not accept a 2 to 4 unit property, whereas the Home Possible will. The Home Possible program does not allow for, the Home One program does not allow for non-owner occupants. So all borrowers must reside in the home if we're going to go with the Home One program. And both programs, the reserves are going to depend on what comes back through that automated decision engine when we run it through LP. Now, Freddie Mac also offers an exciting program called Borrow Smart that gives the home buyer the opportunity to qualify for an additional grant between $1,000 and $1,500, depending on where their income falls, whether it's less than 80% and the property is located in a high needs area. In that case, that grant amount is $1,000. If their income is greater than 80% of the area median income, but less than 100%, and the home is not necessarily located in a high needs area, then they can still qualify for $1,000 in that grant. Now, if you're working with somebody whose income is below 50% of that area median income, that's when we see that grant amount bump up to about $1,500. Now, this is offered in both North and South Carolina. And there is some additional counseling that needs to be followed here. That as a lender, we're going to reach out to the customer and we're going to give them a phone number to GreenPath so that GreenPath can provide them with the additional counseling required for this program. It does cost them $99, but I think the benefits far outweigh the small outlay of cash to be able to qualify for this program. And the assistance can be used in addition to what Jane shared with the North Carolina housing programs. So another wonderful option for our home buyers. So options, let's talk options. Okay, this is where it can get really, really exciting. The programs that Jane spoke of earlier today can be used with any of the base loan programs. So base loan programs, FHA, conventional, VA, those minimum down payment requirements are listed there on the left-hand side for you, but we haven't really talked too much about USDA just yet. Many of you have probably worked with USDA loans, and some of you may not have. It's a program that should be considered for many different reasons. Number one, it gives the home buyer the opportunity to get into a home with 0% down, but there are some caveats. We need to make sure that the income limits fall within the USDA eligible income amounts. And there is a website that we can go out check that eligibility. Is based on family size, and they do consider all household income. So what does that mean? That means if we have a buyer who has other people, other income earners in the home, such as maybe an older child that lives in the home and is working, or a parent that is residing in the home and receiving Social Security income, maybe a girlfriend or another partner that is living in the home, a boyfriend, a spouse that is living in the home that is not on the loan application, all of that income needs to be considered. So it is household income. While we have some flexibility in the DTI ratios for some of the other programs, the USDA program is pretty hard and fast at 41% on the maximum debt to income ratio. They have a reserve requirement that they want to see a minimum of 1 month of a housing expense being collected or being shown on the bank statement in liquid funds available post-closing. So we'll work with the customer to make sure that their bank statements show that. That cannot be a gift. It must be seasoned liquid funds of their own once we start the program. So the pre-approval process is key for buyers that you feel may benefit from this program. We need to get working with them sooner rather than later. The USDA fee is reduced in the PITI. So in the payment, when you look at the conventional option versus an FHA option, you could find that the PMI or the MIP that's required for those other loan programs are higher than what you're going to see for a USDA loan. USDA is just a flat 0.35%. So that's a little bit lower than what we're finding in some of the other programs. There is a guarantee fee that needs to be paid for USDA. It is 1%. It is allowed to be financed into the loan, so it is not an added cost that is brought to the closing table. And that added fee is so minimal in the monthly payment that you're better off to finance it anyway. But if by chance we have extra funds and it wants to be paid, then it can be paid in cash. Now, USDA has a minimum credit score requirement of 620. However, I will tell you from experience that most often you will not get an automated approval at a 620 score for USDA. That will have to be a manual underwrite. There are compensating factors that need to be met. It can be somewhat difficult to go as low as 620, but at a 640, as long as they're meeting all the rest of the requirements there that I just ran through, it should be a fairly easy process. And at 640, we can do 0% down on a USDA loan and then use one of Jane's programs at North Carolina Housing and that Borrow Smart funds. Well, Borrow Smart will go with the first. We can use Jane's programs to cover any of the closing costs and the prepaid expenses associated with the loan purchase. So what does this mean? Other down payment assistance options in North Carolina. There's House Charlotte, City of Concord, Town of Davidson. A lot of these other areas have smaller down payment assistance programs that we can couple along with the program that Jane ran through. So you could theoretically use, if you're purchasing a home in the city limits of Charlotte and your buyer qualifies for, they have three options. It's either $7,500, $10,000, or $17,000, depending on where the home is located. But let's say they qualify for $17,000. You could use $17,000 from House Charlotte. You could use funds from Jane's program. And you can also use, if the home qualifies, CPLP funds, which if you look at the bottom of that list, CPLP, and Jane's touched on it as well, CPLP will give your buyer 20% of the purchase price up to $30,000. So you do the math, you got $17,000 from one organization, $30,000 from another organization. You do the Home Advantage program from Jane without down payment assistance through North Carolina Housing to get the lowest rate possible, and you couple that with the MCC credit. That's a lot of benefit for your customer, and that can take them from qualifying for maybe a $175,000 home to maybe a $200,000 home, and it opens up opportunity. So there's a lot of potential there to qualify for more funds, as long as the borrower qualifies at the base program for the programs with these other agencies, and then of course the property has to qualify. Now, let me talk just a moment about CPLP, House Charlotte, Unifor Consortium, and some of those other programs. They require a more extensive down payment education program. So the Homebuyer Education Program is typically right now, especially with COVID, being done as a webinar. But some of these programs also require one-on-one counseling in addition to the education piece. So we want to get the buyers started with one of those those partners, those CPLP partners, the House Charlotte partners, sooner rather than later, so that when they do go under contract, the education and the counseling piece is already completed. Then we want to make sure that we look at the property and where the property is located, because there are some caveats to the property eligibility. And that's where, you know, as a realtor, we can have that one-on-one conversation about specifics on the property that your buyer is looking at and what they need, and get the buyer pre-approved for some of this stuff up front, so that you're not spinning your wheels and showing homes that are not really going to fit into the right program for the home buyer. And real quick, because I know Dennis is going to be sharing a little bit about this program with you in his presentation, if I'm not mistaken. But if you do not need some of the down payment assistance, that we can look at a renovation option, which Freddie Mac offers 95%. This allows the home buyer to get into a home and fix up the home with replacing roofs, plumbing, electrical, adding new flooring. It really helps them buy the home that they want and build it to be the home that they love, and finance those costs into the mortgage transaction so that they don't have to come out of pocket all of that money. And some do's and don'ts. Let's just talk through this really, really quick. We want to make sure as a team, realtors, builders, lenders, that we are counseling our home buyers on some pitfalls that can really provide some hiccups throughout the process if we're not addressing them up front. So I share this with everyone that I speak with right from the get-go, and hopefully they keep it close in hand to review. But let's just real quickly keep in mind, we need to make sure that in their excitement to start packing, they keep all of their documents handy. We need to make sure that they're not packing away pay stubs, bank statements, and some of those important documents. We want to make sure that earnest money deposits, due diligence deposits, those are coming from their own funds. Now, if they're getting a gift from that, for that money, we need to talk through that so that I can properly counsel them on how to transfer those funds to the attorney and to the sellers. But we want to make sure that it's coming from their account. So we want to have that conversation up front. Notify the loan officer if anything is coming from gift funds. We want to make sure that we are setting that up from the start, knowing that there's a potential of funds coming from a gift donor, to ensure that it's transferred properly. Make sure that your home buyers notify us if there are any changes to their financial circumstances, any job changes, any moves, any raises. And we want to make sure that we remind them not to do anything crazy during the process with their credit, and that we will be pulling a new credit refresh prior to closing to ensure that they are still qualified right before closing. Now, cash money. Cash is not king in the mortgage world. It can't be documented, it can't be sourced, and as a result, it creates a lot of hiccups for home buyers. So please make sure you're talking to your buyers when they get ready to purchase due diligence checks and earnest money checks. If those funds are coming from cash on hand, we need to talk about that, because we need to be able to document that those funds are coming from allowable, sourceable, legitimate funds in their name. We want to make sure that they don't change any jobs, that they don't make any major purchases, that they don't open or increase their liabilities. So just keep that in the back of your mind as you start this process with your home buyers. As Jim mentioned earlier, we're all fiduciaries in this. We're all in it together. And as a team, we want to make sure that we're all sending the same message and preparing our buyers up front for the process so that it's smooth all the way around. And with that, I'm going to turn it over to Dennis. I know that's a lot of information, but thank you again for allowing me the opportunity to share all of this with you.
Thank you, Karen. That was a tremendous overview of the products that Fairway provides, and our realtors in the audience. If I hope you got a lot out of that. And if you're not referring loans or your prospective buyers to Karen, please consider it. And she will get it done for you because Fairway closes a lot of Freddie Mac loans. So thank you, Karen.
Thank you.
And now, okay. And now my friend and colleague, Dennis Smith, is going to talk to you about our Duty to Serve programs. I'm really thrilled that Dennis can make it today because they had 4 inches of snow in Ohio. So hopefully, Dennis, you cleared your snow, and time is yours, my friend.
Thank you so much. I need some of that North Carolina sunshine sent up my way. So thank you for the invitation today. And what a great job by all of the other presenters so far. Today, I just want to talk about some of our products that provide solutions for attainable and sustainable affordable home ownership. I will give a brief overview of each product, and within the slides that we will be sending out, you'll have the opportunity then to look over in more detail. And if you have any questions, feel free to reach out to Jim, myself. And I know that Karen and the Fairway team would be excited to talk to you about some of these programs as well. The first thing I want to talk a little bit about are community land trust mortgages. What is a community land trust mortgage? They are a mechanism that a nonprofit can create and preserve affordable home ownership opportunities, not just for the customer that is buying that home today, but for future generations of permanently affordable home ownership. The way that the community land trust works is that a community land trust program provider purchases the property or has the property donated to them, and they build a home on it or bring the home up to standards. Then they remarket that home to a customer at a below market rate. So I like to use round numbers. So let's say in a market perhaps where there's a $200,000 home, the amount of subsidy that a community land trust puts into that property might be $50,000 or $100,000. So that customer is actually only paying $100,000 or $150,000 for that property. Now, in exchange for purchasing that home at a below market rate, that home buyer agrees to share the equity involved in that transaction with the community land trust, and also promises that when they sell that home to the next customer, that it will be a customer that qualifies for the community land trust mortgage. For this, we have a mortgage offering called Community Land Trust Mortgage Eligibility for single family owner occupied homes. That is not a manufactured home. Eligible borrower types. This is very similar to a lot of the other programs we talked about today, where the Community Land Trust program provider will have specific area median income requirements that the customer must qualify for. The majority of them across the country are at 80% of area median income or below. And some in the higher cost markets might even go up to 115 or 125% of the area median income. What's unique about a lot of these programs that I'm going to talk about today is it builds on the foundation of our Home Possible mortgage, our HFA mortgage that we offer, as well as our Home One for first-time home buyers. And most of these are purchase transactions, although for community land trust, there are no cash out and cash out refinance transactions available. And that is subject to the community land trust approval. One thing that makes these so affordable is that in the community land trust model, the home buyer is getting a mortgage for the improvement or the structure that is on the land, and the community land trust retains ownership of the land that is beneath the home and then does what's called a ground lease to lease that property back to the customer for a minimum monthly fee. And that is how they keep the costs down and are available to offer that at a below market rate. Well, why is this important and why are we talking about it in North Carolina? There's several community land trusts throughout your state. As someone else mentioned earlier, I am not a resident of North Carolina, so some of the unique towns and county names I will butcher if I try to pronounce. So I decided to put a list of the community land trusts on the PowerPoint. That way you have it. And there's several located throughout the state as an opportunity for those customers who may not be able to afford home ownership in the areas that they work or wish to live, can live there through the community land trust structure. And again, the community land trust is to preserve affordable homes over the long term with a community land trust mortgage. It allows for more affordable home ownership opportunities. It preserves housing affordability for the next owner. And through our mortgage offering, we simplify the process, what the lender must do to look at the subsidy provider in the community land trust program. And also, one unique thing about the community land trust is we allow the appraisers to go out there and take a look at the property as if that home is appraised without the ground lease being present. And then we use that value of the appraised value to determine the loan to value. So in the majority of instances for community land trust mortgage, that will put the loan to value below 80%, and the home buyer will not be required to carry private mortgage insurance on their conventional loan. So it's just another way to make certain that that home is affordable. And with many of the programs, we want to ensure that the home buyers are successful, not just to attain home ownership through pre-purchase home buyer counseling, but the community land trust also provides support in post-home ownership counseling and helps those customers prepared for any life events that may change during their time of ownership. The second thing I want to talk a little bit about are choice home mortgages. So on the screen, you'll see a picture of a home, and in your mortgage MLS system, you might notice that in North Carolina, there's a recent property classification called a cross mod. And this is an example of what a cross mod home is. Many of you might not understand what a cross mod home is. And our choice home financing is for that cross mod type of home. So let me break it down a little bit for you. Our choice home financing for those cross mod home is for a residentially styled and constructed home that exceeds the aesthetic and features of many HUD code manufactured homes. So yes, this is a factory built home, but a lot of the amenities and features designed in this home are very similar to site built homes, but at a lower price point because of all of the efficiencies that are created in the factory built process. So the all-in target home price for these homes are $175,000 to $250,000, including the land, well below that of the average site built homes. And we really want to provide parity in financing for this choice home financing of cross mod homes. So we provide our home possible financing for up to 97% loan to value, and all those flexibilities that were spoken to with our home possible product. And this is really an appealing option for many who may be priced out of the marketplace. I know whenever I talk to realtors, they say, I wish I had more homes to show my customers, or man, the inventory just isn't out there. So this is potential for more customers to look at the factory built homes as the high quality homes that they are today. Some of the features of our choice home are minimum roof pitch of 412, a lower profile residential set, so it doesn't have that traditional manufactured home 4 or 5 block foundation. We also include additional energy efficiency items, including higher insulation packages, low E windows, programmable thermostats, and these homes are greater than 1,000 square foot of gross living space and have drywall throughout the interior. So I like to say that this really can change the perception of factory built housing and manufactured housing. For customers looking to purchase this home, homes that meet choice home eligibility will have a label inside of the home that looks like this image on the slide, and that qualifies them for the choice home financing for those terms up to 30 years with as little as 3% down. So I wanted to touch on that very briefly, as I know that North Carolina is one of the states where many of the manufacturers are delivering cross-mod homes that are eligible for choice home financing. I know that Karen talked a little bit about our choice renovation mortgage. If we look at today's housing supply, it's aging. 80% of homes that are in the marketplace are at least 20 years old, or 109.6 million homes, and 54.8 million, or 40% of those homes, are at least 40%, are at least 50 years old. And when I think about the recent exercise I've gone through with my son looking at homes, he's a millennial, and he's looking for the high quality fixtures in a home. He's looking for upgraded technology in the home. And a lot of those homes may not have that, or some of the older homes in his price point just may need a little tender loving care. So a choice renovation loan presents many homes that could be available for customers that you may have trouble finding and placing in a home. Maybe they're not enough homes listed in their price point. It's an opportunity for you to help them see the potential in a home. It is a single loan that allows for the renovation or repair of the property. It also funds up to 6 months of the principal and interest, tax, and insurance payment. Because we know that a lot of times as the renovation is occurring, they may still need to live with their parents or rent, and it is a great option. An additional feature of choice renovation is it can pay upgrades for resiliency to help withstand natural disasters. And I know in North Carolina, I had a couple of my vacations cut short on Topsail Island because hurricanes coming through. This is a great product that can help those customers add resiliency to their home, either before one of those natural disasters or as a result of a natural disaster. And we do permit up to 75% of the as completed value of the appraisal. So the appraiser looks at it as if the work is completed. I won't go into the details about contingency reserves, etc., but I did want to touch upon some of the eligible renovations. It has to be an existing dwelling. So they cannot raise an existing dwelling down to nothing, and the proceeds may be used to renovate or repair a property that's been damaged as a result of that natural disaster, and the proceeds may not be used for personal property. So it can't use to replace televisions or couches or furniture, with the exception of some of the new appliances that you would find in a traditional home transaction. And then I also wanted to just touch briefly on our Green Choice mortgage. Our Green Choice mortgage is very similar to our Choice Renovation mortgage, in that it is geared toward someone who wants to make improvements to a home, but these are specifically energy efficiency homes and energy efficient improvements. More than half of a household's energy usage goes towards their heating and cooling, and research shows that home buyers today are looking for those energy efficient homes, and what a better way to help with sustainability than keeping your utility and energy costs in place. So we offer our Green Choice mortgage product. It allows for the financing of energy and water efficiency improvements or repairs through the refinance of an existing home, or a customer may purchase a home and within one loan include the energy or water efficiency improvements into that home. A unique characteristic of this is that they look at the as completed value of the home and allow 15% of up to 15% of that as completed value for the energy efficiency improvements. And we do this in a single close loan, so the purchase and the energy efficiency improvements are wrapped up into one and can be combined with any of our low down payment offerings with an LTV up to 97%. What are some of the energy efficiency improvements that qualify? Everything. There's a lot of items that the customer can do themselves, such as caulking or weather stripping, installing programmable thermostats, perhaps adding insulation into the home. But there are some things that will require contractors to do, such as replacing the air conditioning or heating units to replace them with higher energy efficiency, replacing windows and doors. And this is one of the few products that does allow for that customer to purchase high efficiency refrigerators, water heaters, light bulbs, washer and dryers to go to a more energy efficient home. So this is one of the rare cases where a mortgage will permit you to buy some of those personal property items. And with our Green Choice Mortgage, we do permit the financing of solar panels. We do require an energy audit for any time that home has more than $6,500 in aggregate improvements, except when solar panels are installed. Then the appraiser must address the cost efficiency of the solar panels that are included in the home. Again, I just wanted to touch briefly on the Community Land Trust, Choice Home, Choice Renovation, and Green Choice Mortgages. They can be combined with our low down payment mortgage products such as Home Possible, Home One, or HFA Advantage. And it allows you to expand the pool of affordable homes to show your clients. It gives your clients the confidence to see that home's potential and see beyond its existing state and see it as the place that they want to live with the features that they want in their home. Through our products, we increase sustainable home ownership opportunities, and through these, it can help improve home values within your community. With that, I just want to thank you again for your time today, and I'll turn it back over to Jim.
Thank you, Dennis. More great Freddie Mac programs to share with our North Carolina Realtor audience. And Rachel, you want to bring us all on and let us know if we have any questions in the Q&A box? So Dennis, Karen, and Jane, if you can power up again. Thank you.
Absolutely. So one of the questions that I've received a couple times is, are we recording this? So I just want to reiterate to everyone that we have recorded today's session. We know there's a wealth of incredible information that's been provided by all of our speakers. So after today's session, once we process the recording, we'll be sending an email out to all of you with a link to the recording in addition to copies of the slides. So you'll have immediate access to all of the links to the different programs that were discussed today. In addition to that, we've had a few people ask about the CreditSmart instructor program. So I just want to reiterate that I will include Jim's contact information along with the contact information for the rest of our speakers. So you can reach out to Jim directly to learn more about how you can become an instructor for the CreditSmart program. We do have one question right now in the Q&A. From Tanya saying, can the choice mortgage be used on a manufactured home?
So that's a great question, Tanya. So I know we have choice in a lot of our offerings. So a choice home is a manufactured home. It's just built above HUD code standards with those specifications that make it more site built. Such as an attached or detached garage, porch, dormers. And if you remember, I showed an image of a label. The actual manufacturer builder will take that label and place it on homes that are eligible for choice home financing. And our choice renovation and green choice mortgages are also eligible for manufactured homes. She said the green mortgage, yes. So the green choice mortgage is eligible for manufactured homes. We just have a little different cap in the amount that you could use for energy improvements. And I believe the max on Green Choice is $50,000.
Wonderful. Do we have any other questions from any of the attendees today?
And Rachel, I just put my email address in the chat box if anybody needs it.
Wonderful. Thank you so much for sharing that. All right, it looks like all the questions have been answered so far. So I just want to thank all of you so much for all of your time today and for all of just the incredible financing programs that you all have and all of the work that you're doing to bring home ownership to North Carolinians. We truly, truly appreciate it here in North Carolina and very much appreciate having you all here today to bring all these updates to us.
You're very welcome, Rachel, and thank you for having us back. And hopefully we can do this again in the future. And Karen, Jane, and Dennis, thank you for accepting my invitation to join us today. It was great content, and I really hope that North Carolina Realtors, saw value in it. So thank you, Rachel. Thank you, everyone.
Absolutely.
Thank you.
Just a reminder, we'll be sending out an email with a link to the recording, and we look forward to seeing all of you on the next webinar. So thank you, everyone, and have a fantastic afternoon.
Wonderful.
Thank you.
Bye.
Thank you. Bye.